learn how to underwrite properties? Well, I'm going to give you the behind the scenes content of my coaching program where we go deep with one of my investor partners, David Weinstein. He runs his own commercial lending company. He's a really, really smart guy. We're basically going to do a absolute foundational, all the terms you need to know around underwriting commercial real estate properties. So if you're new to the real estate space, specifically the commercial world, and you want to understand how to evaluate commercial properties and what every single one of those terms mean, this is going to be a fantastic starter video for you. Really, really impactful video. I promise you guys are going to get a ton out of this. Let's dive right into the training. Let's talk about some terms. What obviously people correlate interest rates is cap rates, right? Because obviously cap rates have to trade a smidge, within tandem of interest rates. So let's talk about cap rates a little bit. Let's understand exactly what they are and how to find out how to figure out what the cap rate is.
Okay, let me share my screen. I'll show you a kind of a mock-up of underwriting. This is a basic underwriting template. If you take a look over here, you see this thing called cap rates. Some of you may be familiar with this. This is kind of the first metric you should know in underwriting. And what a cap rate is basically the net operating income divided by the purchase price. You see it here, it carries over here. And in this case, it's 8.89%, which means that you're purchasing it at essentially 8.89 times your NOI. And that'll be, in this case, $30 million. And that number is, subjective completely. If you change this number, if you change your purchase down to, let's just play with this and put it down to 20 million. But essentially, if your purchase price goes down, your NOI remains the same, which means you're getting a better deal. Your cap rate goes up, right? Because you're buying it at a much better multiple.
Yeah, your cap rate changed on the right, so you can mention that.
Oh, it did change there. Okay, yeah, I was looking here. Let's do that again then. All right, there we go. Right. Your cap rate went up to 13. Right, and the reason why is because your multiple is much better. You're buying a much better deal. So basics are the reason why we look at cap rates is because it's a kind of across the board indicator of, regardless of property, regardless of asset, it just tells you where you're at. Higher cap rates are good. Lower cap rates are bad. It means the pricing is too high or higher than. The number one thing you want to do when you look at a property is understand the cap rates of the area. And that's equivalent to, in the residential world, asking, what the market price for this, for a two-family is. Commercial properties don't trade essentially at purchase prices because they're so different from one from the other, but they do trade at cap rates. Cap rate is the great leveler, so to speak. It gives you, you can buy a $5 million building or a $30 million building and use one as a comp for the other based off cap rate. You can say, okay, the $5 million building sold at an 8 cap. So that's telling me that, the larger building, the area supports 8 cap purchase prices. All right, does that make sense? Debt service. Okay, I'm switching over to the debt service tab. Debt service is the next important metric to look at. Cap rates do not take any debt into account. It's a straight all cash purchase. And the reason why that's important, though, you might ask, hey, who's buying an all cash building? Why do I care? It's very important because debt changes often and with each individual, right? So one guy might walk into the same bank and get, 70%, the other guy might get 60, the other guy might get 80. And therefore it's very hard to evaluate a property based on a subjective formula. So you got to have this leveler, which is basically applies across the board. It gives you the income to purchase price ratio. That's why we don't include debt in cap rate. Debt in actuality is really, really important to you personally as an investor. So you have something called a debt service coverage ratio.
Now, the cool part also about this is that, look, cap rates are pretty easy to do back of the napkin, right? You guys can literally do this, on your calculator on your phone, right? You can get if you're talking to somebody over the phone, hey, my building brings in a net operating income of $1 million. You can take $1 million, divide it into 8%, and you're going to get a number, right? You're going to get $12 million, right? And say okay, well, at a $12 million purchase price, that's an 8% cap rate. If you're talking to a buyer who goes, I buy 8 caps, 7 caps, 9 caps, whatever the heck they're looking for, you can quickly do back of the napkin stuff. Obviously, when you're speaking to somebody and they go, yeah, I'm having net operating income of $1 million, it's really hard to understand what the debt service coverage ratio would be, right? It's to figure out a debt service coverage ratio on the quote back in the napkin is a little bit more complex. However, we'll be able to show you how the ratio works, and then I'll show you how I kind of look at it on my phone, so you guys can do some quick back in the napkin numbers. Math was the only class I ever passed in high school. Just realized that I could do math pretty well in my head. So I'm just going to try to speak out loud the way I think about it, teach you how to basically do it on your calculator on your phone. So you guys can do it quickly, while David just brings up the next spreadsheet.
So here's just another format that kind of lays out that coverage ratio more easily. All right. So again, here you have your net operating income. You got your cap rate, which is not here. And then you got your debt coverage ratio. Debt coverage ratio basically looks at your annual principal and interest, all right, which is right here, in this case, $292,000, and divides that by your income. And this ratio tells you that you're making 1.86 times that, your income, your NOI, right over here, is 1.86 times your monthly payment, which is right over here. Your net operating income, your free cash flow, so to speak. This is the money that comes to your pocket. This is the money that you got to pay the bank. The bank wants to know that you are making greater than 100% of your monthly payment. And the reason is simple. The reason is the bank knows that there are unforeseen expenses, there are unforeseen vacancies. They don't want to live on the edge. They want to make sure you're making more than you're paying them. Now, how much more do you need to make? So that is dependent on the loan type and the bank and the asset class. But typically you're looking at a ratio of 1.2 for multifamily to 1.3, 1.4 for riskier assets. Retail, office is getting now, like if they're getting loans at all, they're getting 1.5, 1.7 debt coverage ratios. Multifamily is always the safest assets. You can always get the best debt coverage ratios. So
yeah, and also real quick, just to add, this is and we're going to talk about another term, cash on cash, shortly. But this is going to give you guys some reference of when you're speaking to an investor and you go, I think this is a good deal, and then they go well, I'm not making any money, so just because it's a decent cap rate doesn't mean much. So this is the biggest proponent, debt service coverage ratio. Obviously this deal, David, whatever deal this is, this looks fantastic. A 1.86% debt service coverage ratio is wonderful, which means you're cash flowing like crazy. Very, very good news here. So this would be something that you would love to see. You'd love to see a 1.86. This is not very typical, okay?
Correct. This is not typical. This is amazing. Now, let me show you what happens when rates change or terms move and why it's so important. Because until now, we focused on this side of the sheet, right? We're talking about income, expenses, cap rates. That's all beautiful. The problem is the issue as an investor, the personal decision, if you should go into the deal or not, depends almost entirely on the type of financing you're getting.
Yep.
Right?
It's the make or break of a deal, 100%.
It's absolutely the make or break of a deal. So you're going to be looking at what you can do here. This number is only relevant up to a point, but it's not your bottom line number. Let's look at a couple of factors that play into debt service coverage ratio. Okay, one of them is rate, and obviously interest rate. Let's look what happens. Let's just play with this. Let's change it to 7.5%. Okay, so if you saw what happened is this drop from 1.86 to 1.68. A drop of only almost 20 bips, which means you're getting lower. Again, this is still healthy numbers. I'm just gonna override the system and give you more realistic numbers of 300,000. So let's just assume the NOI in this deal, whatever the case may be, is 300,000. You will not be able to get a loan with 0.93 DSCR. There are three things here that can change that. One of them is the rate, right? If rates drop back to 5%, well, suddenly you're at 121. You can get a loan. You can get a loan that you're asking for, which is 75% loan to value, 3.8 million, no problem. And let's say rates, so rates is one kind of trigger, one lever that affects your debt coverage ratio, which affects how much money you can get. The other one is obviously loan to value, right? Here we're at 75%. But if let's put the rate back to 6.5, right? We're just going to work off of that. You're 102. You cannot get this financing. You can't get a loan. What you could do is get a smaller loan, right? So if you get to 65, if you request a 65 LTV, you're almost there. Get to 60, and you're good. You're good. You're above 1.2. You'll get this loan. The problem is your proceeds dropped by 15%. I mean, you got to come in with that difference in cash if you still want to buy this deal. Again, you can lower your proceeds to hit this number, but this is what a bank looks at. Essentially, this is all the bank looks at. Everything else is secondary. The first time you submit a deal to a bank, this is what they're going to do. They're going to take your income expenses, put into their own worksheet. They're going to stress test it, which we'll talk about. And then they'll look at the debt coverage ratio. If it works, then they'll start looking at everything else, tax returns and verifying your expenses, verifying your income. But this is number one that a bank will look at. And you should be looking at it too. This is number one of understanding if you can do this. Okay, let's move this back to 75 LTV. This loan is not working. There's something else besides the rate that can help you get up. Besides moving the number and besides moving the rate, there's one other thing, and that's the amortization schedule, right? So this is input currently at a 30-year amortization schedule, which is really the most you're going to get from a typical loan. But let's just assume for a moment that you can get a 50-year amortization schedule, right? Just so you understand the concepts, right? So if we move this, if you can amortize your loan over 50 years, that means you're paying down your principal over 50 years versus 30 years, you're getting much better. And if you can do it over 100 years, you're basically able to get a loan now with the same money at the same rate. So let's dig into why that is. Amortization is, for those that are not aware, is over how many years is the principal payments broken out to pay back the loan. You might have heard of interest only, right? Interest only loans are like it sounds, there's no principal pay down, you're paying interest. Most commercial loans have a amortization schedule, which means a principal pay down schedule. Now, that does not mean that that's how long you have the loan for. You might have a 5-year loan with a 30-year amortization schedule. The schedule is simply how long you break down the payback of principal, right? And if you have a 5-year loan with a 30-year amortization schedule, when you get to 5 years, you got to pay back the remaining principal, usually through a refi or a sale. Yeah, go ahead.
Let's ask a quick question. What are the typical amortization rates? I mean, like term-wise, amortization terms.
Okay, so on a typical multifamily, again, being the safest asset, you're at 30 years, all right? And that's because banks are comfortable with getting less of their principal back essentially every year because it's multifamily and they're comfortable with that. When you get to more aggressive or riskier asset classes, if you're looking at, let's just say retail, right? So you're typically looking at 25-year amortizations, which affect you very much on your debt service. So you're paying back more every month. It's coming out of your cash flow every single month. Let's put the rate back to 5. So we have some numbers here, right? So again, let's look at this as a 30-year. Your debt service works. It's 1.2, perfect. At a 25-year, it does not work. It's 1.1, right? And that's just because you're paying back more of your principal every year, which is in theory good because you're paying back your loan faster, but it also eats up more of your NOI, more of your cash flow, and you cannot support the loan the way the bank wants you to support it. Amortization, you want it to be as high as possible, but banks are on risky assets. I've seen 20 years, I've seen 15 years. Hospitality, things like that, hotels, things that are kind of riskier. They want to get paid back over a shorter time span. Okay, so that's pretty much the DSCR.
So real quick, also, I want to do this really quick with you guys. I want to teach you my back of the napkin way of doing this really fast. And I want you to know, this is not a perfect way of doing it, but I want you to know, this is okay, real quick, am I going to be cash flow positive or not? So ready, what I'll do is that let's just take this type of deal. What's the property value is $5 million. So what you guys can do is this. You essentially can take whatever your net operating income is. So just keep that in mind. So David, if you want to set that up as you keep it as 300, I guess that's fine. Let's do the math here. If you take a $5 million purchase price and you're going to multiply that by 0.7, that means I'm going to put 30% down. I'm going to do 70% leverage. You do this on your calculator. I'll kind of follow along with you guys. Okay, you get $3.5 million. Right, so yeah, he'll follow along on the screen. Okay, so I'm doing a $5 million purchase. You're doing 515. It's the same kind of math. Okay, we get $3.5 million. Obviously, I'll play with that. Fine. Yeah, do $5 million with us. Okay, simple. Cool. Perfect. So what I'll do, okay, for 5% interest on this type of loan, what I'll do, and with principal and interest, I'll add 2% to whatever mortgage interest rates are at. Let's just say if interest rates are at 5% right now, which they're not, I would say probably do 7, right? Do 7% real quick, David. So principal and interest. What's funny enough is that it almost comes to an exact, it's not perfect math, but what you can basically do is you take the 3.5 million and times 7%, I get 245. Now, obviously, with 7, it's a little bit more complex. Whatever the interest rates are, I basically add a point or 2. So let's see where it ends up. If I knew interest rates were 7% right now, let's just say I take times, I take 8%, right? Just to be safe. What's 9? Hold on. Because I'll typically do 2 above par, right? Whatever interest rates are. So if it's really 7, which I know it's rough, times 9%, 315. There you go. This is exactly what I'll do. Do 2% above whatever market interest rates are right now. If you take that number, I get $315,000 in debt payments. Okay, principal and interest. Now, again, I'm a smidge over. The point I'm trying to make, though, is that because we could probably get 7. So, David, go back to 7% real fast so we can see what that comes to. So it's 296. I'm 20K over, but I'm being conservative. The point is I'm a smidge over. If you take 2% above par, now I can know what my debt payments are. So if I know my NOI is 300 grand on this deal, and I do a quick back in the napkin math on my calculator of 2% above par, right, of the loan, I'm clearly going to know 315 is higher than 300,000. This is going to suck, right? I'm not going to cash flow much. Is this making sense to you guys? Like really just take 2% above, right? So I'm going to know really quickly before I even go to my buyer, this is going to be a really terrible debt service coverage ratio. And they're going to have to come drastically to they're going to have to come very heavily to the table with a down payment. However, if David changes to $4 million. So now let's just say that I can negotiate a $4 million purchase. Okay. You do the same thing. So right, $4 million times 0.7, 2.8 million times, I'm going to do the same times 9%, 252. Okay, I'm a little bit above what the debt service coverage ratio is, but I know that I'm going to cash flow 50-ish grand a year. So now I take 50 grand a year and I go, okay, well, I have to put down $1.2 million to buy the property, right? The 30% plus closing costs and everything else. I'm going to come out to 1.3 million bucks. This is a really quick telltale story that my cash on cash return, which we're going to talk about shortly, which is what everybody's really looking for, sucks. You take 50 grand and divide it into 1.2. We're going to talk about this shortly. But the point is, like, this is a quick back of the napkin. You just take 2% above par interest. Like if you go to CNBC, the link that he left before, that's the 5-year treasury. Banks sell 2% above that typically, and then you're going to do 2% above that. And if you do that calculation on your phone, it's a very quick back in the napkin way of saying, am I profitable or not? You can dive back into it. So let's do cash on cash returns.
So on this one, let's go back to kind of a couple of other important numbers to you, to your investors, and so on. Let's look at cash on cash. So here's your cash on cash. Cash on cash ratio is simply your investment, your initial investment to your cash flow after debt service. So it's not NOI, all right? NOI is just the cash flow of the building. Then you got to pay your debt service, and post debt service, you've got, it actually lays it out very nicely for you. Here's your gross income, or your expenses. This is your NOI, all right? But then you got debt service. You take away debt service, and all you're left with is 1.5 million out of the total of $4 million. All right, look at that ratio. And that's reality. I mean, you're looking at about 25 to 30% on a good day.
I mean, that's great.
That's pretty good. Yeah, that's pretty good. I mean, people these days are seeing much, much less than that.
Yeah, I mean, people are seeing 5 and 10% sometimes, guys. Like, which is not great.
Correct. And then you have these splits, which I don't want to get into right now. We can talk about that another time. And typical investor splits. Let's jump down here. You're looking at a calculation of net to investor, right? These are additional expenses. Net to investor, 1,295. And the cash on cash ratio is the money they put in, which is on the summary, the equity of $10,990,000. So it's the money they put in to the money they're getting out. All right. And that's 11.8 a year. So they're looking to year one. And then
just for reference, guys, like this is a cash on cash return is as simple as if you put your money in an account per se, this property is an account. This property is an account. You're putting your money in this property, and then you're going to earn a rate of return on your money, right? Like if you guys put your money in Robinhood or a high yield savings account, how you hear these 5% BS numbers, right? They're going to pay you 4.9, whatever, 5%, whatever that is. That's your cash on cash return because there is no debt cost, right? That's your actual return on your money. So if you invest $10,000, 5% of your money, you make $500 a year. Make $500 a year. Now, the cash on cash is this very same principle. So you basically you invested $1 million. In this case, it's probably substantially more than $1 million on this $40 million deal. You invest X amount of dollars, okay? And that means every year, after all of your expenses are paid, you return X amount of dollars on your money. Cash on cash is not including appreciation. It's not including depreciation. It's not including equity pay down. Cash on cash is specifically just the cash flow of the property after all expenses paid in proportion to how much money out of pocket you are. So if you put 100 grand into a property and you're making $10,000 a year on that property, you're making a 10% cash on cash return. Investors would love 10%. They would love a 10% cash on cash return, right? I mean, obviously more would be fantastic. They would probably get away with 6, 7s and 8s if the deal has great upside. I'll let you continue, David.
Yeah, correct. Exactly right. I mean, this is an important number. This is either you or your investor. It's just pure cash flow. There are many other benefits, obviously, to real estate. Appreciation is one of the huge ones. Depreciation, tax benefits are another huge one. But this is simply cash flow, cash to pocket in relation to the amount of cash you put out. And then, as time goes on, obviously on every pro forma, things will change. You're going to refi. Every couple of years, rates will go up. You'll sell the property, and there's different cash flows.
Yeah.
So that's cash on cash.
Last term we're going to talk about, guys, before we dive into any deals that you guys want. I just wanted to make sure we talked about this before we start doing that. This is a property that me and David are buying right now. We're in contract on to buy. It's a retail center David, I'll let you kind of explain it. Obviously, let's talk about IRR, where, what that means, how to calculate it.
I'll talk about IRR, then I'll show you how it plays into this this actual real life underwriting. IRRs, for those IRRs need a couple of previous knowledge, like net present values and present values, and probably some of you have done some finance 101 in college or high school. But essentially, I'll try to simplify it.
And real quick, IRR is internal rate of return.
Internal rate of return. What that looks at is the number, the percentage that you would need on an alternative investment to be equal to this one. Okay, and that's a very complex way of basically comparing two investments side by side, a hypothetical investment and your current investment.
And you guys can think about stocks. Stocks is like a compound, everyone thinks about like the S&P 500, like an index fund. Everyone says that the S&P 500 makes 8-9% or so a year, every year. You guys ever look at compound interest calculators where you can see that it goes up like over a period of time? You guys know what I'm talking about? IRR is exactly that. Right? Like the S&P 500 has an IRR of 9%, right? Because that's an annualized return. Where like if you left your money into a stock account 10 years later, you have an internal rate of return of 9%, whatever it is.
So if we have an IRR right over here of 46%, okay, that means that essentially you would have to find a deal that is putting out 46% per year to be equivalent to this investment. IRR is a leveler, also like a great leveler, so to speak, like we spoke about cap rates. You can have any size purchase, but you can compare cap rates. You can compare returns with any size deal or any length of deal. Okay, so if you might have a 40-year time frame on one deal and you want to compare it to this deal that only you're going to get your money back in 5 years. IRR allows you to do that. It just gives you one number that will compare both. So the higher the IRR, the better the deal is. I mean, this is a great, fantastic deal. It's returning 46% over the life of the deal. Essentially, IRR will take into account the amount of time it takes to generate cash flows, including the initial input and the outflows. But however that works, essentially the higher you should be looking at, the higher the IRR, the better the deal. All right, and we can do a separate class if anyone's interested in kind of getting it's again, you got to have kind of a little bit of training in understanding the depths of how that's calculated. But higher IRR, the better. Right, 38 is great, 10% is okay, 5% is not great. You should be putting it in treasury bonds.
Most of the time, you got to think about it like this. If you guys are selling a deal and there's very little cash flow, like we've talked about, like let's just say the debt service coverage ratio is high. The debt service coverage ratio is low. It means they're not making a lot of cash flow, right? Because they have high debt payments, not a lot of income. So that means they're making a low cash on cash return. And then you go to IRR and the internal rate of return is like 7%. It's like, why on planet Earth would I take the money that I have out of the markets, right? You're talking to a big time investor who's got a lot of money. Why would I take my money with zero energy and effort at 9% to put it into a piece of real estate that produces 7%? Nonetheless, if it brought in 12% or 13% with work, right? Because you're like 9% with zero work or 13 or 14% with work. So you have to take this understanding in your head and go like, okay, well, if I'm a rich investor and I bring someone and someone brings me this deal, do I want to do 9% or 10% with no work or 14, 15% or whatever with work? It may be some are worth it, some are not. We look for deals that are ideally pencil out to 25% plus internal rates of return for our investors minimum. Ideally, this one's a fantastic one, which we found, actually produces 46. So it's a very, very, very good deal. We actually negotiated seller financing on this one, which obviously helped. But I think that the easiest way for someone to predict internal rates of return really quickly, really fast, guys, because this is going to be really high level, and I'll let David kind of take it away afterwards to explain it more in depth, which is internal rate of return calculates this. Okay, it calculates every dollar I collect in cash flow throughout the entirety of owning this property, okay? It first, number one, takes the entirety of the cash flow I'm collecting over time. It understands where I am today, purchase price, right? 1.825, you see on the far left-hand side, 1.825 purchase price. How much money I had to invest into purchasing the property, which I think comes to 419, but I think the total is 490, actually the bottom center. So 490 out of pocket, raised total, dead center at the bottom. So 490 out of pocket. Then it calculates over time how much money I've collected on my 490. Like it's going to calculate all the cash I've accrued, right? The cash flows of the property.
All your cash flow, correct.
Yep. So if we go to deal cash flow in the dead center, it says comprehensive cash flow or deal cash flow at the bottom. Yep, that's fine. So right there, deal cash flow. So it basically shows 490 going in And then every month I'm collecting a little bit of, every quarter, this is quarterly. Every quarter we're collecting a little bit of money on my money. And then at the very end, you'll see, a big lump sum check of 690 under the 16th and then 20. I think there's a refi checked by,
there's various assumptions, but this is a second refi, but there's every couple of years you get this lump sum.
This is basically saying if I were to invest or you were to invest 490,000, if you go back to the main sheet real quick on the summary, it basically would say that based on all the cash flows, including my refis, all the monies that I've returned on my initial investment, I would return a 46% annualized return on this, right? My return personally would be 46% on this investment, because basically all it's calculating is money returned over time and the rate and the speed in which I've returned that money back to me. Because
I want to point out how this is different than cash on cash that we spoke about before.
Yeah,
right?
And the last thing I'll say to you guys, because this is basically this is the easiest way to think about IRR, and this is what really clicked it for me. Okay, if you let's take the bank investment. Okay, let's take that bank investment. They say 5% interest in the bank. Okay, you invest $10,000 and they say we're going to pay you 5% on your money. Now, if you receive that 5%, that's 5% annualized. So that's $500 a year on your money. Now, let's just say I brought to you an investment that was, I said, hey, I'm going to give you, let's change it and now say 10 grand. I invest 10 grand. I'm going to return you $10,000 on your investment. If I take 10 years to pay you back your $10,000, that's a 10% annualized return or a 10% IRR. But if I say you're going to give me 10 grand and I'm going to pay you back 10 grand in 1 year, that's 100% IRR. 1 year versus 10 years, now it's 100%. And if I say, hey, I'm going to pay it back to you in 6 months, now that's a 200% IRR. So the speed in which the speed in which you return capital is what increases IRR more than anything. The amount of it and the speed in which you return it is how you can increase IRR. Does that make sense?
That is absolutely correct. And that's extremely important because you may be getting, like in your example, the same amount of money. But if you're getting it down the road in 5 years, it's definitely much less exciting and much worse IRR, therefore, than getting it sooner. Very important. And cash on cash deals with your actual month-to-month cash flow. It does not take into account the length of time you're going to be getting this over, when you're going to be getting it, and it doesn't take into account the lump sum exit either. All right, so this is actually in a way much more important because this gives you the bird's eye 2,000-foot perspective of what your entire deal is returning from day one till the end. Cash on cash will give you, month by month. You may have zero returns on your capital. You may have zero cash on cash for 5 years on some deals, but then get back, 800% of your initial investment, and then your IRR may be better than getting money every month. So they're really two separate kind of formulas, and it's not one or the other. You got to look at both. Some people have cash flow needs. Some people have long-term investment horizons. So there's no right or wrong here. It's just different perspectives and different ways of looking at a deal and what it returns.
So this is guys, listen, the biggest companies around the world, Blackstone, Vanguard, all the, State Street, all these huge organizations, they care about IRR more than anything. Like when they're pitching to an investor to invest $50 million, $100 million, $1 billion, they're saying, hey, the IRR of this investment will be X. This is what we're projecting. IRR is incredibly important. And when you're talking to investors and you say, hey, I have an investment for you, it looks like it's around a 20% or 30% or 5%, whatever it is, IRR, you're going to make them think some type of way.